$1.17 trillion. Read that again. $1.17 trillion. That number is not a forecast from a bearish newsletter. It is not a worst-case scenario constructed by an economist with an agenda. It is the documented, officially measured total of American consumer credit card debt as of the final quarter of 2023. The highest nominal figure ever recorded in the history of United States consumer finance. Michael Burry ran the numbers behind that figure. He studied the composition of who holds that debt, at what interest rates, and with what realistic capacity to repay. He examined the delinquency trends building beneath the surface of that aggregate number. He cross-referenced those trends against historical configurations that he had studied in detail before anyone else recognized them as dangerous. And what Burry found does not match the narrative that Wall Street, the Federal Reserve, or mainstream financial media have been constructing for the past 3 years. Today, we examine exactly what that number means, why Burry believes it signals a structural fragility that the market has not yet priced in, and what history tells us happens when the consumer credit cycle finally turns. Michael Burry is not a fixture of financial television. He does not appear on panels to reassure investors or provide comfort to the consensus. He is not employed by an institution that requires him to be constructive on the economy. Burry is a former medical doctor who retrained himself as a financial analyst by reading primary documents, filings, prospectuses, 10K reports, bond indentures, mortgage prospectuses, with a methodological discipline that most professional investors do not apply. In 2005, while every major bank in the United States was expanding its exposure to mortgage-backed securities and every rating agency was assigning investment-grade marks to instruments built on structurally defective collateral, Burry identified the failure by reading the documents that everyone else ignored. He built a short position against the American housing market. His own investors tried to redeem their capital. His prime broker questioned his margin requirements. The financial press had no interest in his thesis. In 2008, Burry generated returns of 489% for the investors who remained with him, while the global financial system recorded its worst collapse since the Great Depression. The same methodology, read the primary source, follow the arithmetic to its logical conclusion, act before the consensus recognizes what is happening, is the methodology Burry has been applying to the American consumer credit market. The conclusions that methodology produces are not encouraging. To understand why Burry's analysis of consumer credit carries the weight that it does, it is necessary to understand what happened to the financial position of the American household over the past 4 years. In 2020 and 2021, the United States government deployed approximately $5 trillion in fiscal stimulus through a combination of direct payments, enhanced unemployment insurance, small business support programs, and expanded credit facilities. The immediate effect on consumer balance sheets was dramatic and visible in every data series. The personal savings rate spiked to levels not observed since the Second World War. Credit card balances contracted. Delinquency rates fell to generational lows. Economists and financial analysts pointed to these metrics as evidence of a consumer that had emerged from the pandemic with structural financial strength. What Burry identified, and what the subsequent data has confirmed in detail, is that this apparent strength was not the result of improved earnings, increased productivity, or genuine balance sheet repair. It was the mechanical consequence of government money flowing into household accounts while normal spending channels were simultaneously disrupted. The moment that stimulus liquidity was absorbed and withdrawn from the system, and the moment the Federal Reserve began raising interest rates at a pace not seen in 4 decades, the underlying condition of the American consumer began to surface. Not through a single dramatic data point. Through a sequence of deteriorating indicators that, read together in the way that Burry reads documents, describe a credit cycle turning in slow motion toward contraction. Burry's thesis centers on what the data supports calling the consumer credit mirage. The argument is this. For much of the post-pandemic period, consumer spending data appeared healthy. Retail sales were solid. Unemployment remained low by historical standards. On the surface, the American consumer looked resilient, and the mainstream narrative embraced that appearance. But Burry's analysis focuses not on the output of consumer spending, but on the mechanism funding it. What Burry has consistently pointed to in his public commentary and disclosed portfolio positions is the acceleration in revolving credit. Credit card balances carried month to month at high interest as the primary fuel for that apparent resilience. The consumer was not spending from income growth or accumulated savings. The consumer was spending from debt expansion. And the cost of that debt, in a high interest rate environment, was compounding at rates that had no meaningful historical precedent in the modern consumer credit era. A mirage looks real until you move toward it. Then the distance between perception and reality becomes undeniable. The first dimension of Burry's analysis is the delinquency data. This is not peripheral information. Burry has consistently argued that delinquency curves are among the most accurate leading indicators available for consumer credit cycle stress, more accurate than employment data, more accurate than sentiment surveys, and far more accurate than aggregate retail spending figures that blend healthy and distressed consumers into a single misleading headline. As of the second quarter of 2024, credit card delinquency rates at major American banks had reached their highest levels since 2012. Data from the Federal Reserve Bank of New York's Consumer Finance Tracking showed that over 10% of credit card balances had transitioned into serious delinquency, defined as 90 days or more past due, within a single 12-month measurement period. To place that figure in context, the last time delinquency rates moved at that velocity was the immediate aftermath of the 2008 financial crisis, when unemployment was spiking above 10% and the economy was in acute contraction. The fact that similar delinquency velocity is now appearing during a period of officially low unemployment is precisely the kind of anomaly that Burry's methodology is designed to detect. It means that something inside the consumer balance sheet is under stress that headline employment figures are not capturing. Burry reads the footnote that the headline cannot see. The second dimension of Burry's analysis is the interest rate transmission mechanism. When the Federal Reserve raised the federal funds rate from near zero to over 5% between early 2022 and late 2023, the effect on long-term fixed mortgage debt was limited in the short term by the fact that most homeowners had locked in rates during the low-rate period. But revolving consumer credit card balances, reprices continuously and immediately with the prevailing rate environment. By the end of 2023, the average annualized interest rate on outstanding American credit card balances had exceeded 22%. That is not an approximation. That is the highest measured rate on revolving consumer credit in the modern history of United States consumer finance. Burry has explicitly drawn a structural parallel between this dynamic and the adjustable rate mortgage reset mechanism that accelerated the 2008 collapse. In that crisis, borrowers who had taken teaser rates on subprime mortgages saw their monthly payments jump dramatically when those rates reset to market levels. The consumer credit equivalent is not a single reset event. It is a continuous compounding pressure operating on balances that grew during a period of near zero rates and are now being serviced at rates that consume a structurally disproportionate share of household disposable income, month after month, with no relief in sight. The third dimension Burry emphasizes is the savings buffer. The American personal savings rate collapsed from its pandemic peak of over 30% to below 3% by mid-2023, one of the lowest sustained readings in the post-war era. This is not an abstract macroeconomic statistic. It is the measurement of how much financial cushion the average American household has available to absorb an income disruption, a medical event, a job transition, or a sudden reduction in credit availability. When savings rates are at generational lows and credit card balances are at record highs and delinquency rates are accelerating, the consumer has no margin for error at any level. Burry's historical analysis of similar configurations that appeared in the period preceding both the 2000 and the 2008 downturns, shows that the absence of that savings buffer is what converts a manageable credit slowdown into a self-reinforcing feedback loop. Lower savings force greater reliance on credit to sustain consumption. Greater credit reliance at elevated interest rates accelerates delinquency. Accelerating delinquency forces lenders to tighten standards. Tighter lending standards restrict credit access precisely at the moment when households depend on it most. Each stage of the loop makes the next stage more severe. Burry has seen this structure before. The fourth dimension connects the consumer level to the financial system. Credit card receivables, the future payments owed by cardholders, are not held exclusively on bank balance sheets. They are securitized into asset-backed securities and distributed across institutional portfolios, insurance companies, pension funds, money market instruments, and structured credit vehicles. The rating models applied to these securities use historical loss assumptions calibrated during periods of lower interest rates, higher savings rates, and tighter underwriting standards than those that prevailed during the post-pandemic credit expansion. Burry's analysis of the 2008 crisis was built on exactly this kind of gap. The divergence between what rating models said the risk was and what the underlying documentation actually described. He has indicated that he sees a structurally analogous condition developing in consumer asset-backed securities. The gap between rated risk and actual risk, Burry argues, is not yet visible in prices. It rarely is, until the delinquency trend reaches a threshold that forces model recalibration. By that point, the institutions holding these instruments are repricing risk under duress, rather than in advance. Applying Burry's framework at the individual level means asking the same questions he asks about systems. The first question is whether your personal debt profile mirrors the macro pattern he has identified. Are your revolving balances growing? Are you carrying credit card debt forward month to month? And do you know the precise effective interest rate you are currently paying on each outstanding balance? Burry's methodology begins with quantification, not intuition. The second question is the exit model. In every position he has analyzed, Burry asks what happens when the conditions that created the position reverse. For personal consumer credit, the equivalent question is what happens to your monthly cash flow if credit availability contracts. If your credit limits are reduced by lenders responding to rising system-wide delinquency, or if your income experiences any degree of disruption. The third question, Burry's framework implies, is whether your financial behavior is based on primary analysis of your own numbers or on a consensus narrative telling you that everything is fine. The consensus in 2007 said the housing market was fundamentally sound. The prospectuses said otherwise. Burry read the prospectuses. Today, we traced Michael Burry's analysis of what the data describes as the consumer credit mirage. The dangerous divergence between the surface appearance of consumer financial resilience and the structural reality of record debt balances, historically unprecedented interest rates, depleted savings buffers, and accelerating delinquency curves that few mainstream analysts are treating as the warning they represent. Burry's record carries a specific lesson. He identified the 2008 collapse years before the consensus acknowledged it existed. He was early. He was pressured. He was systematically right. The consumer credit cycle that Burry has been tracking does not require a triggering catastrophe to reverse. It reverses when the arithmetic of debt service costs, income growth, and credit availability reach their natural mathematical limits. According to Burry's framework, Those limits are not somewhere in the future. They are here, in the data, for anyone willing to read it. Thank you for watching.